Good afternoon and welcome to today's webinar of Funding Solutions for Franchise Development in the Current Environment. This is the next installment of Manning Fulton's Franchise Feed webinar series designed to provide you as franchise executives with relevant, actionable guidance on how you can grow and protect your brand as you navigate these challenging times. My name is Richie Taylor and I lead the franchise law practice at Manning Fulton. As one of the leading franchise law practices, Manning Fulton's experienced practitioners focus daily on helping each client grow and develop their brand through franchising. It's my pleasure today to welcome two of our franchise friends, SHERRI SEIBER and GEOFF SEIBER, the COO and CEO, respectively, of FranFund, the leading full-service funding solution focused exclusively on the franchise community. Franchise finance is the lifeblood of franchise development. Accordingly, it is important for franchisors and franchisees alike to understand the current financing environment and the tools available to help franchisees fund their franchised businesses. You will have the opportunity to submit text questions to today's presentation by typing your questions into the questions pane on the control panel. You may submit questions at any time during the presentation, which questions the presenters may address during the program or at the end of the program as time permits. If we are unable to address your questions during this session, someone will contact you afterwards to discuss them with you. Today's program will be recorded, and in the coming days, you will receive a shareable link to view the program, which can be addressed along with other resources at franchisefeed.net. Now I turn the time over to SHERRI and GEOFF for today's program.
Hi, thanks, Richie, and good afternoon. Thanks for the nice introduction, and thanks for the great team at Manning Fulton. This is our second year doing this, and we really look forward to it this year. I think we were kidding a few minutes ago about it would be nice to be at the hotel actually doing this instead of having to do it remotely. These are challenging times, as you said. There's a lot of different experiences going on in 2020 for all of us, for sure. And I did want to point out, though, Richie, that just for you, this is only the second time that I have had on a tie since mid-March. And the other was for the fan meeting conversation. So I felt like I didn't want to let you down and let the lawyers down in this situation. But with all the trends and experiences, I mean, SHERRI, what have you been seeing?
Well, first I want to thank Richie again for including us today, and well, thanks for jumping right into the topic, GEOFF. But we're going to get into some details for sure of the various funding solutions available today, but I think the listeners here would really like to hear your perspective on the overall lending environment in today's landscape and possibly what we can expect to see in the coming weeks and months as we head towards 2021.
Well, if you go back to the last time I wore a tie pre-COVID, there were already changes happening in the marketplace from 2019 to 2020. If we were using 2019 as a baseline, the environment was becoming more conservative. The environment was becoming and requiring more documentation. And I think there was a real trend that is going to continue after this COVID era of gathering a lot of data about franchisor brands and using those much more in the underwriting process across the country for various banks. In other words, as the data is now becoming more and more available, they are learning how to use that and interpret, and that can be very good, or that can lead to certain situations we have to overcome. FranData had shared in their presentation at IFA back in February at the national meeting about these trends, and while so much has changed from that time till now, I think it is very important to realize that some of the things that we're going to talk about today have only been accelerated by COVID. Lenders see the same news that we do. They have the same access to information. They have the same or even more access to data, and those are getting factored into their lending decisions in the way that they are looking forward. And they also are recovering from the PPP loan frenzy. I think that everybody on this call likely went through it, and I know, Richie, I went through it with you and a lot of your clients there at Manning Fulton. And the The banks were as new to it as anyone, and they tried to get that money out as quickly as, absolutely as quickly as possible, kind of all hands on deck for their staffs, and they're still recovering from in the loan processes in a lot of these situations towards closings with all of that additional work that's there, and now the additional work that's going in to the forgiveness aspect. But I think the one great thing to look at is that lenders are still lending. I mean, they are in a situation where they need to lend money to make money, and they are looking for ways to be able to do this in a conservative manner, in a more conservative manner. But they're still looking at each opportunity and each brand and each potential franchisee as an opportunity to make money for them. So the doors are not closed. This is not like the last time we went through this crisis when literally it was like, don't even bother. This is much more of a trying to find a way to continue to support their clients and support their businesses, even new ones, even new startup businesses. I think that's probably the best summary is, while the rules are different, and we're going to get into some of the rules that are even more different because of COVID, there is still an optimism within the marketplace. We don't see the pessimistic group as not completely won over the day here as of yet. And as part of that, Sherry, the SBA has released, in addition to all this, a new SOP that's been around underway for almost 2 years, and they released that document, that 514-page document, 2 weeks ago. And I know you've read it cover to cover and understand it infinitely at this point, but can you talk about some of those changes?
Love to, Jeff. Thank you. Well, most lenders use SBA products for franchise loans exclusively, almost, especially for those startups and expansions from 1 unit to 2 or 3. I like to always point out that the SBA, or the Small Business Administration, an arm of the government, they don't actually lend the money, but they provide a guarantee on a portion of the loan to incentivize lenders to consider loans for these first-time business owners and emerging franchise systems. So in this new SOP document that Jeff referred to, that goes into effect on October 1st, they created some new terminology for SBA loans, and they do this periodically. But these terms that we're going to talk about today are hot off the press. One of them is the SBA 7A standard loan, and then there's the SBA 7A small loan. We'll also cover a working capital loan, which is a hybrid, basically, of the 7A small loan and the 7A express loan that is only offered by a small group of lenders. This loan is not a named product, so you can't go on SBA.gov and actually learn about it. Did I go too many? Here we go. So the standard SBA 7A loan is for loans over $350,000, and the small loan is for loans under $350,000. So pretty easy distinction there. Both of them are used for brick and mortar type businesses. They include working capital and other expenses such as the cost of vehicles or trailers in the loan amount, working capital, etc. The primary difference to the lender is in the underwriting criteria, but to the borrower, the documentation requirements are basically the same. Let's first talk about this working capital loan. This is an SBA product, but again, it is not a named product, so you won't be able to go and find it. But it's a loan amount with a maximum of $150,000. This has been a very popular loan for service-based franchise systems, and those are businesses that usually don't require a lease. They don't require build out or construction. This loan doesn't cover any titled vehicle, and it can't be used to purchase an existing business. It's really for a business that is, in fact, the specific number is 14 days. It has to be within 14 days of opening, and it's to provide that working capital that the owner needs to get off the ground. Again, this is a pretty unique product that's only even offered by a few lenders across the country. Jeff, you want to talk a little bit about the underwriting guidance here before I go deeper?
Well, you know, there's a lot of things going on here for banks right now, and I think that's important to remember as we're working through some of these things we're going to talk about today, and as you're starting to work with your lenders or work with us as we're working with our lenders and understand some of the situation. The first is that, you know, in addition to the new SOP and trying to digest that document, and I will tell you that for once, I may be the only time that that we've seen some of this new guidance come out, that they have cleared up and cleaned up an awful lot of things, and they've done a good job on filling out some or taking out some of the gray. They've really tried to give the lenders guidance. They've tried to put it in a much better organizational manner where that questions can be answered quickly and results could be consistent. I guess I know that they'll continue to tweak this over the next little bit as everybody kind of finds perhaps the stuff that it may be even yet unclear and try to adjust that. But this is a big leap forward, I think, for all of us in lending and for all franchisors to knowing what does work, what doesn't work, what things can they expect and what things can they not expect. But in addition to this new SOP, these guys are still dealing with, as I said earlier, the PPP overlap of taxing on staff and on now as we go into the forgiveness provisions for the next between now and the end of the year. I got guidance on some of that even yet this morning on how and when the payments are going to start, how and when the bank is required to take those payments from you as they are ready to give you forgiveness. Some of these things that aren't really even out of the marketplace, the banks are dealing with all of that as well. So there's a lot going on there. And just in case that wasn't enough, we have a whole new set of guidelines that came out on August 7th about COVID. And those guidelines are, a lot of them are for specific industries. A lot of them are for the specific requirements that are going to be in every loan as it closes in this current environment. And so not only are they dealing with all of these other factors, they are also dealing with how to follow those rules. And you know, for those of you who are unfamiliar with some of this, the real reason this is such a big deal is that, as Sherry said earlier, the SBA guarantees the loans, right? But for those guarantees to stay in effect, they guarantee a portion, typically, let's say 75% of the loans guaranteed, but a typical deal. 25% is on the bank. Well, in order to get that 75%, if there is a default in some way, all of these rules have to have been followed. And if the government finds that they haven't, they deny the guarantee. So this is very serious stuff for the banks to make sure they're understanding and then executing on the additional rules here. But Sherry, why don't you talk about some of the qualifiers that we found in this August 7th document, because that's an entire new set of things.
All right, well, for both the standard 7A and the small loan, the credit score and the personal equity injection requirements are generally the same. The lenders are going to want to see a credit score of 680 or above with a favorable financial history and a personal cash injection. Lately, we've been seeing this at around 15 to 20%, but depending on the specific project, this could actually go up to as much as 30%. Now, here's one of the changes we've seen. Collateral has always been a requirement as part of this program, but prior to COVID, we'd seen some creativity in this area, but they've gone right back to the standard book definition of it now, and they're wanting to see real estate, equity in real estate as collateral, so preferably a home and a home with equity, so that satisfies that requirement. There are still some leeway there, especially if the loan is in Texas or Florida that are homestead states. There's some alternatives, but generally speaking, they like to see real estate as collateral there. A factor that surprises a lot of the borrowers that we talk to is the lender's requirement for a significant amount of post-closing liquidity funds. What they want to see is enough funds to cover loan payments, lease payments, your own personal expenses and debt, usually for that 9 to 12 month period after the loan is dispersed. The other part of this is they want to see a solid outside source of income. Again, as Jeff mentioned earlier, the lenders are seeing the job market and the changes out around the country just like we are, and so they're adjusting accordingly. So again, if a borrower has already left their job or been laid off, they could get that outside source of income from their spouse, but it's going to be a requirement. So I'm going to go back a little bit and talk about these working capital loans. Jeff, did you want to make any comment about where this loan originated?
Yeah, I know we missed a slide there, so we'll just backtrack just a little bit and touch on this. I mean, this, as you saw some of the new nomenclature there that you'll start hearing now on the standard and the small, a lot of people had lumped these $150,000 loans into a program called express loans. And the express loans could go up to $350 and had certain different requirements and that sort of thing. And those programs are still being phased out. But the thing to remember about is the express loan, quite honestly, was misnamed. Express was meant as an express approval by the SBA for the loan for the bank. It was never meant that the deal was going to move so much faster for the actual client. And there was some reduced documentation and things in write-ups that the bank had to have in those areas. So that the people used to always say, well, how come my express loan's taking longer than some of the standard loans? Well, if the deal's complicated, it's complicated, even if it falls into that bucket. So as this goes away, don't think that anything has really changed much on the other for the borrower itself, just on the bank documentation side. But the working capital loan is really a 7A small loan program loan. And Sherry, you can go through. Why don't you go through what they're going to need on the closing for that, and how this program actually works going forward. That's enough on the past.
Yeah, I'll have to get in the weeds just a little bit to explain this. Otherwise, it can be confusing. But a lot of things about this product has changed since it was introduced 3 or 4 years ago. First of all, I mentioned earlier, the loan will fund no more than 14 days from when the doors are going to get open, and it's meant for working capital. That means there's no disbursements for construction. That's why we say it's good for service-based businesses. So the good news, though, is the business itself acts as the collateral, but the borrower will have had to cover the items on the closing checklist, which includes an executed franchise agreement, business insurance, any licensing or storage, any vehicle, anything. If you have to have a specific industry certification, all of those things will have to be done prior to the loan closing. And so anything spent before the loan closing is going to be considered your down payment. The borrower is not going to be reimbursed for this, whereas in other SBA loans, they can. So while they tout the beauty of a 10% equity injection, you can see from this closing checklist I showed you that number's pretty tough to get to. So the qualifiers for this loan, the same credit score requirements, the same. The two factors that have surprised people are the post-close liquidity requirement of $50,000 liquid. And that's simply because the lender does not want to see you get your doors open and then not have any money in the bank. And the borrower shouldn't want that scenario either. So that's sort of a safety valve before you start generating revenue. But they also pay attention to the debt to income ratio. But in this loan, you can actually use projected income as part of that income that you use to qualify with. But they want to see that at more than 50%. So that's a great loan if you can match all of these qualifiers. Jeff, what do you think the franchisor should be asking for from prospective candidates to give them confidence to move them forward in their own development processes?
I'll tell you, as you guys can see, there's a lot changing, and you know what I think everyone should try to factor into their development processes as they move forward is what we're calling a meaningful pre-approval. You know, old school banking, branch banking, somebody comes in and says, yes, I'd like to get a loan. Can I get one? And they're talking to the person that's at a desk in the lobby, and they go, oh, yes, we would love to do that loan. Can we get started? Can I get your package? And then you don't hear from them forever. And then they say, oh, no, we're really not interested. You know, you as a development person might hear, well, my bank was excited to get my package and they took it and I'm expecting an answer any day. Well, all the banks at that stage and the way that things were done then was they wanted to take a look at everything, and then they'd figure out what they wanted to do. And it was kind of not the best way for the actual client to do that. So, you know, I think what you want as a developer is to make sure you get a solid, meaningful pre-approval, and not just oh, if everything is perfect, we will do this loan letter, or I mean, you can tell if these letters are just kind of standard boilerplate stuff, or if they really have some teeth behind them. And what I mean by that is that there has to be some data given, some data analyzed, and some actual scoring done before any of those pre-approval letters really have any meat behind them. And I say that because there are several scores that the SBA now allows lenders to lean on in the course of protecting their guarantee. If we go back to that arena, and the one you may hear or you may never hear it's kind of finance speak, but it's the SBSS score, and that is a score that the SBA has developed, an algorithm that they have developed, that if you are above that, you can take a pretty good stance in that you're going to be able to get that guarantee done, assuming all the rest of the stuff is there. Well, so that score needs to be run, personal credit scores need to be run, and then all of this outside COVID stuff needs to be, you know, incorporated into that right now before those pre-approval letters mean what you may think they mean and what your potential franchisee may think they mean. And so we've you know, FranFund, we do have this all internal. We do have the scoring system internal. We use 2 different bureaus. We use the FICO. We blended it together, take the SBSS algorithm model and come out with the scoring, and then are able to have a conversation with the client. And in most cases, we will take that one step further and actually pre-shop those loans to one of our portfolio of lenders. So you can have that can happen. There are groups out there that can do that for you, versus just if they're relying on their local bank, unless it's a long and deep relationship that they've done other business loans with them before, you may want to make sure you're getting all the information as you go through it. You know, the other thing, Sherry, that's happening, and I know that, and I know that these pre-approvals now are taking a little bit longer than we were able to do pre-COVID. They're a lot more. We always had the detail, but the COVID situation in the different industries and the impacts and what states are open. I mean, you know, if that state's not open in the COVID world, we can't pre-approve a loan there until they are, if that industry is closed. So there's again, changes happening on that all the time. And, you know, every state's different, every mayor's different. Some states are moving forward, some are back. All of that factors into the pre-approval. But in addition to that process being deeper, there's also the timing of the SBA loans from what we were used to in 2019. And you want to talk about that for a minute?
Yeah, absolutely. They've actually moved out to 45 to 60 or more days right now, to be honest. Especially lenders that did participate in the PPP loan program. They basically did 10 years worth of their normal production in only 3 to 4 months. And then there was the clause in the CARES Act that provided 6 months of free payments and interest to existing SBA loans. and SBA loans, new loans that could be closed, funded, and in full servicing by September 27th. That's coming right up here. So there's banks scurrying around trying to get as many of those loans under the wire on that program as possible. Those two things really put a strain on lender capacity. And remember, some of those lenders and underwriters have been working remotely through this. So that brings its own set of challenges when you're working on a complicated project like a loan. So part of the SBA underwriting guidelines were published in early August, and they were specifically around COVID-related questions. And so there's something called adverse effects due to COVID form that has to be completed by the borrower, and an adverse change certificate. There's those two things are being required. So basically what lenders want to know is, how is that business handling the impact of COVID so that they can successfully operate? How are they social distancing? How does that reduce capacity in their space that could affect revenue? Those are all major things.
You know, I can weigh in there just for a second on all of our staff and all of our lender staff and everybody that's kind of associated with finance right now. You know, they are bent over at the knees, gasping for air with their tongues hanging out. In that, you know, there has just been one stress point after another through this, with a lot of importance to your potential clients, to your referral sources, to people's actual livelihoods and things. And I know that we all went through the PPP issue where that you felt like, you know, you had to succeed at this. You had to succeed at this. So there's all that tension, all that angst of these guys trying their best to get things done. And then, you know, they kind of worked through that. They've still got all the closings that were in process when COVID hit that they're trying to accommodate. And now, as Sherry said, there's in one of the things that was in the CARES Act, and I think most people are maybe aware of this, and if you weren't, well, you missed it, but they gave six payments on the loan, not loan forgiveness, but actually made payments on the loan so it was not taxable for up to 6 months payments for any SBA loan that was out there that was in good standing at the time of COVID. And they extended that to any loan that closed before September 27th. Well, obviously that was something that then everybody wanted to get their loan closed by September 27th. And so you've got, you know, our entire FranFund staff on this trying to get as many of those closed. You've got every banker out there, bank loan program, trying to get these closed. And you've got clients with the same anxiety and push going on as we head through the PPP process. So, you know, there's except people are now, you know, one more crisis, either seasoned or worn out, depending on how you want to look at it. But in addition to that, the COVID questionnaire and the things that are going on as far as on the move forward, how do we get your brand, or how do we make this easier for your potential candidates coming through to get through some of all of this that's going on? And our franchisor relations team has been very proactive with working with brands to get the COVID questionnaires out to them, review them, help them get them ready to go so that they can go into the loan packages for your franchisees, whether you would use our services or someone else's. I mean, this is we want to assist where that does not bog you down at closing, or that you have a chance to answer those questions that are needed in a meaningful way, and where we can get the loans, where we can get approvals through the credit committees because of the answers that you've been able to provide. There is no reason for those loans to be held up through that. And another piece of the SOP that's going on, that is an additional remedy or an additional way to access capital in this environment, is the ROBS program, the Rollover for Business Startup program. If you are, we're going to go into that program here briefly in case you're not familiar with it, but there were a few things there that I think were important in the SOP. It is a faster way to get to perhaps get access to capital, and a better way to get access to capital for some people. And it's also it also can be used in conjunction with the SBA loan as an alternative. It can be the cash injection. It can be where you set and balance the payment you actually want to have, or you can set it up if you've got the capital in those non-qualified accounts, or in those qualified accounts, that you can do that without having any payment at all. But a lot of lenders didn't completely understand it. A lot of lenders looked at it suspect. A lot of lenders were, I'm not quite sure how that works or what I'm supposed to do, because their interest is protecting their guarantee. And so the SBA and this new SOP has put together a really correctly defined, a real much simpler way to understand that process and how it works, and what the bank should be responsible for. So I think we'll see a lot more attention paid this, and a lot more acceptance of this product by lenders in the future, both for new startups or for some of your franchisees that may be looking for expansion or acquisition in a way to access capital they have not had before, because again of the banks that are understanding of the product. And I think there are several pros and cons to this. I mean, there are a few things that you need to take into account. One is that these dollars come from what you may want to refer to as retirement accounts, or qualified money accounts that the money's been put aside, pre-tax, and you can access that capital with no penalty, no tax at this time. When you do pull it out personally, of course you're going to pay taxes on it. It's not, it is, we say it's not tax free, it's just tax deferred, but you would have that same issue no matter how much your account grew. But it does allow you perhaps not to have to collateralize that you're not collateralizing your home with that. You're not, with that investment, you're investing in yourself. You become the investment, not the stock market, not some of the other things. Credit scores aren't a factor. It's just a great way to access capital that's on your balance sheet that would be kind of off limits otherwise. Now, a couple of things that the new policy does: there always should be a third party. You're going to have a third party administrator to administer the retirement plan. Sherry's going to go into how that works in just a second. And you will be operating as a C corporation instead of an S corporation or an LLC. And there's going to be a lot of people that throw up their hands and go, "Oh my gosh, that's just terrible." Well, I think as your attorneys or as your accountants look at that, there are a lot of positives to being a C corporation. And it's just that you will need to pull out things through payroll early on, as opposed to dividend structure, and it's not going to change your net on the outside versus having the ability to access that capital. So I think that we're going to see a lot more movement, I believe, into this product over the next several years, especially as we come through the economy as it sits today. But it's something I think you should be aware of, whether or not you go down this path, or not. Your franchisees would most likely need to be aware of this. Sherry, why don't you, without getting too much more into the weeds on my end, why don't you go ahead and explain how this transaction actually works for those folks that are unfamiliar with it?
Yes, I will absolutely do that. It's a good time to point out, though, that Rob's process takes 3 to 4 weeks versus the loan process, which is taking significantly longer than that right now. So this is a great swift access to capital. Basically, it's beautiful in its simplicity. The process is governed by the IRS and the Department of Labor. And what you end up with at the end of the day is a 401k profit sharing plan, which has been sponsored by your corporation, just like any Fortune 500 company would offer. To execute this program, we create a C Corp, which will be your operating entity, and we design a 401k plan that's sponsored by this corporation. And then to complete the process, we transfer qualified retirement funds, and this can be from several different types of accounts: an IRA, a 401k, a 403b, and several others, into the newly formed 401k plan. And then as trustee of that plan, the borrower or the owner would purchase stock in the newly formed C corporation. So at the end of that transaction, the new 401k has shares of stock equal to the value of the investment, and the operating account has cash that can be used for any legitimate business expense. So I like to, say it a little differently. It's like calling your stockbroker and saying, hey, buy me 100 shares of stock in Apple. At the end of that transaction, you've got 100 shares of Apple stock in your investment portfolio, and Apple has cash. You don't know exactly what Apple is doing with that cash, but you hope they're doing something to increase shareholder value. And that's exactly the same thing that you hope in investing in your own 401k, in your own company. That's the same way the ROBS process works. This is the most appealing part of it, is that if you've got, say, $150,000 qualified money and you do the ROBS transaction, you are able to immediately use all $150,000 of that money. Whereas if you take a distribution, if you're under 59.5, you're going to have to pay 10% penalty for that early withdrawal plus whatever your current income tax bracket is. In this example, we used 30%, which is probably not even an exact bracket, but gives you an idea. So it would cost you $60,000 to access part of the 150. If you do the ROBS transaction, you get the entire amount. So the $60,000 that you can use today. Now, I also like to mention to people that this is not a get out of tax for life. This is tax deferred, but the tax requirements happen much later in the transaction when you go to exit the business, or several other ways we could get into. I'm going to spend just a minute right now on other sources of working capital for existing business owners. The right solution for any specific situation is going to depend heavily on what the circumstances are of you needing those funds, and what the tolerance for risk is on your business, and what cost you're willing to pay to actually access those funds. But a really fast and low cost option is to take a loan against your marketable securities, excuse me. That's a pretty fast transaction that you handle with your wealth manager. There are other options where you can obtain business credit cards, which can be a popular choice because in the introductory rates are usually very low, 0 in some cases, for say the first 6 months. So if you just need a quick injection and plan on paying that right back off, that might be a good solution. But be careful of when the loans or the interest rates do jump up to the normal rates. They can be pretty high. Merchant cash advances are a good idea for existing businesses if that works for your operation. Home equity loans or a home equity line of credit is always something that's out there. And for a while in franchising, I think that was a largely used method for actually paying franchise fees and getting into the business. And that can still be done today, but we typically advise our candidates or clients to save that ability to draw on home equity for rainy day. So such as needing working capital for, let's say your franchise brand wants to do a special unplanned marketing campaign and you need the funds to do that. That would be, something that you could draw on for that. And then of course you can always go back and do a ROBS or a rollover transaction after you're up and operational. Slightly more cumbersome, but it absolutely can be done. And then if you just need an SBA working capital loan, it would be slightly less rigorous to obtain that while you're up and operational. So those are all things that you can keep in mind. But Jeff, I think as we, go towards the end here, I think you have some great advice for franchisors and their franchisees who may have been challenged the past few months or that are planning for the future. I mean, what are some of the things that they can consider doing to help their businesses?
There is we've thrown out a lot of acronyms around here and a lot of things, and even as we've refined and tried to simplify this presentation, I hope everybody understands there is, quite frankly, a lot going on and a lot of new things that are happening and a lot of things that are positive and a few that are going to make things a little bit harder. But part of that, I hope, that shows you is that you need a toolkit in this area. You need a toolkit in the finance area, both for your brand as a franchisor and as being able to give direction to your franchisees. And what I guess I'm saying, well, part of this, and I'm going to throw out, throw out another acronym that is out there in banking operations, and you may have heard it. It's called KYC, and it came out of quite frankly 9/11, and it was where banks were started to require to know your customer, and all of the fail safes that have been put in to make sure foreign money's not moving around, and all of those things where you have to be in front of people and sign. You can't just open accounts the way that you used to be able to, and those things are actually audited, and banks are punished if they're not doing all of those KYC processes and procedures correctly. I like to say we should reverse that, and that we should all take the provision, both as a franchisor and advice to your franchisee, is that you need to KYB. You need to know your bank. You need to know the bank that you're dealing with in both your operating accounts and in your day-to-day operations and in your lending situation can provide for you what you need. And what do I mean by that? I mean, you want to know, you want the principal in that bank or someone that is a decision maker in that bank that can help you know you. And know you in a way that set up a meeting with them annually and review your financials with them, no matter how small you are. Make sure you're getting, because if you're asking to do that without being required to do it, that's immediately going to put a gold star in your file. You tell them that you want to share your budget projections with them, and here's where they're going and how they may be able to help you do that. Again, you're going to get a gold star. You then are going to begin, and as we all know, bankers, especially for your franchisees, they are incredible networkers. And if they know your business and know the success that your franchisee is having and know the things that are happening in that group, they are going to be a great mouthpiece for you going forward. But where this became truly evident of the people who had those type of relationships when this COVID hit and we ended up in the PP loan process, what were the banks that did the most, that were at the forefront of getting the money out the fastest? It was the regional banks and the smaller banks. And why? Because they knew their customers and the customers knew their bank. And so it was easy for them to process those things. When you get sometimes the banks that are, and I'm not, there's nothing wrong with using a larger bank if that's the bank that fills your entire needs, but make sure you're finding at least that you're getting to decision makers within those banks where that you're able to get access to their expertise and being able to help you develop financial plans, lending plans, growth plans, and primarily they will help you set up initially smaller business lines of credit, and that can be expanded larger and larger each year. And you just keep with them. And as you're looking to expand your business further, or you're looking to acquire a competitor, or you're looking to acquire additional equipment or things, they are going to be great assets to you. I mean, I like to say that you almost want to look at your board of directors as a franchisee, not your governance board, but as the people that your professionals that you interact with as a franchisee or a franchisor, both your legal team, and you're going to have great opportunity to meet obviously Manning Fulton here and their group. Your accountant should be part of that team, and your banker, and while we help facilitate those loans for your franchisees, and we can make sure that we're putting them in the right products in that area, we're not that banker that you're looking for. You're looking for one that can expand the totality of your business and know what's happening for them. When those things are there, you've really set them up for success. And And because I'll tell you, some incredible business advice for a franchisee or for anyone at any size, depending on where you're at, can come from the bankers, because they have to learn to read the tea leaves every day. And their credit committees every week are completely locked into what in the heck is happening in both the local marketplace and the national marketplace. And them giving you advice on, it may not be a good time to do that, or you may want to jump on this right now, can be, incredibly valuable to you as we work through, especially times like this. So I would say that if there's, in addition to all of the stuff you learned today, if you can start to think differently, in that including that banker and including those financial folks in your decision-making process early, I think would be a real takeaway from this conversation today. I also want to talk just a little bit about how, as we all went through a lot of things on the lending side and a lot of things on the financial side, including, the CARES Act and the different additions to the CARES Act and all the guidance that came. I can't say enough about what the IFA did through that process, the International Franchise Association. I'm sure you guys are all familiar with it. Those guys are bent over at the knees with their tongues hanging out, also at a time when they're, due to staff reductions, they have a smaller group that's doing. They got 2/3 of the team doing 3 times the work, and they've done a tremendous job on getting some of this stuff through for the small business side, and continue to be strong advocates for them. And if you are not a member of the Franchise Action Network, I would encourage you to get on there, get where you can immediately have access to your congressmen and senators, and help with those, help become an advocate and help them get our government leaders' attention. I know that Richie and I are on the supplier board together, and both a member of the governmental relations team, and that's how we first met. And I will tell you that from something that, oh gosh, I'm on governmental relations with an attorney, this is going to be fun, it's turned into a really good friendship. And then all of a sudden, it's gone to the forefront over the last few years on how to push our organization forward. So I appreciate Richie's time on that committee as well.
Well, thanks, Jeff. And that wraps up what we wanted to talk to you about today. And thanks again to Richie and Manning Fulton for this great opportunity. I want to brag a little bit about the FranFund team for a moment. We've been proud and happy to work with over 300 franchise brands and their candidates on a regular basis, along with many franchise consultants across the country. We've been named top funding supplier by Entrepreneur magazines for 3 years in a row. We are not ourselves a bank, so I don't want anybody taking that away. We facilitate loans. We have a lot of relationships across the country, as well as the ROBS program. And just thanks again for this opportunity to share a little bit about what's going on at FranFund.
Thank you so much for this great program. We had a couple of questions, Sherry and Jeff. The first one was, do you think that the government will make the loan guarantee more expansive during this recession in order to help spurn more additional lending, as they did back in 2008?
I assume that you're referring to making the guarantee more, moving to a 90% guarantee or something on that, right, in that way. It's talked about. There's no question it's talked about, and there's no question that it was successful. But the reason I'm going to say I don't see it right now. We may see it in 2021 for sure, but right now there is still a lot of liquidity in the marketplace, and a lot of money that wants to move, that banks want to move. They're restricted much more by the COVID restrictions than they are by the credit. And I don't, at this particular moment in time, it's not the lack of good credits, which the 90% guarantee would help. It's much more we can't open businesses in states that are closed, and so, or in industries that may be restricted. And so, until we see that there's that need, I don't see it coming, and it may not be needed, but it is in their, it is certainly in their toolkit, and it was successful last time when that was the issue. And so I would think that they'll go to it. They've gone to an awful lot of things, and you know, in trying to make this all work, and I think that you'll see that interest rates too are going to be, you know, pretty low for a long time. I think if everybody saw the chairman of the Fed saying that, you know, he's looking out through at least 2023 for us to be in a very, very low interest rate environment. I think that's, you know, on the one hand, you know, it's, oh my gosh, what does that mean? Or does he expect the economy to need that during that time? But I think it's also encouraging to know that they're thinking in that direction and not looking to try to battle inflation with some sort of unneeded rate raise.
Great. And then how is the best way for a brand to develop a relationship with FranFund in order to so you get to know their brand better, and how does that help?
I'll take that one,
getting
Richie.
franchisees underwritten.
Yeah, I'll take that one. There's a number of ways to contact us, info@franfund.com. Through our website, there's a way to enter information. And if it's a franchisor, our franchisor relations team will reach out to them, make sure we understand what that brand's all about, what's the total project cost, what are some of the nuances that would be helpful for us to know ahead of time, provide them with any kind of collateral they might need to introduce us to their candidates. We're really proud of that franchisor relations piece of our process, so we would love to work with any franchisor that's interested in sending their candidates to us.
The other thing too, Rich, and I think, you know, there's a lot of people in the office that'll probably chuckle at me saying this, because I was the person that they when we had to start working from home said, you mean Jeff's going to actually have to start to understand the technology that we use every day? Is that following our LinkedIn or our Twitter feeds or those sort of things under FranFund will also give you access to some of the stuff like we're talking about today in real time. I mean, we try to get this stuff out. We've got a great staff in that area that tries to get these type of feeds out right away. And then always with links as to here's where you can learn more. So it's not just the website, it's the social media stuff as well. That if you're following actually the FranFund brand, you'll get up to the minute updates, and we do not fill you full of spam and a lot of other things. This is really a communications device for us.
So when do you find that it helps brands to introduce you to their prospects?
I'll take that one also. Right now, with all the information we just shared about SBA underwriting guidelines and the value of pre-approvals and just making sure we have a home for those loans, or making sure the candidate has options, the earlier the better. We don't mind talking to a candidate early in the process. It's also very helpful for the franchisors we have a consistent relationship with. They value the fact that we will, in some cases, prevent them from having to spend a lot of time with somebody who then is unable to move forward because the funding's not available to them. Conversely, if they do find out early that the person has options, then they can confidently move forward with the franchise investigation, and we stay in lockstep with that process so that we make sure that they have the money available when it's time to sign the agreement and move forward. And so our process is really tight in terms of constant communication, and that has worked very well for us, for the candidates, for the franchisors.
One of the things, Richie, too, that we can do is, you know, our FranScore product that we talked about or a bit, you know, throughout this is and using the credit scoring models and actually pulling credit, you know, true credits on the clients. That report is free. We pay all the fees associated with that for folks when they sign, when they go in, and it's also a soft pull on their credit, because we are not we are pulling it for informational purposes, not for the actual credit decision, because the bank will pull one directly at the time the credit decision is made. So it is at some point, depending upon how that franchisor's development process is, they can find out where all of this might stand by being able to pull those reports from us. And we just look at that as a cost of doing business for us. There is no charge.
That's great. Well, thank you, Sherry and Jeff, and thank you everyone for attending today's webinar. If you have any questions regarding the information presented, please contact Jeff and Sherry, and they will arrange for someone to assist you. In the coming days, you'll receive a follow-up email with a shareable link to view a recording of today's program. We thank you for joining us today. Have a fantastic day.
Thanks, guys.